Good evening. We begin tonight with breaking news from the global financial markets, where extraordinary turbulence has sent shockwaves through commodity trading floors and left investors reeling from dramatic price swings in precious metals. On Thursday, both gold and silver experienced severe declines from record-high price levels, marking one of the most volatile trading sessions in recent memory for these traditionally stable assets. The yellow metal, long considered a cornerstone of financial safety during times of uncertainty, suffered a staggering drop of nearly $500 per ounce. Meanwhile, silver, which had been riding an unprecedented wave of gains throughout the month, tumbled by nearly 12% from its peak. These developments unfolded against a backdrop of significant weakness in major technology stocks, particularly those connected to artificial intelligence and cloud computing sectors. The magnitude of Thursday's movements in precious metals markets cannot be overstated. Gold, which had climbed to extraordinary heights in recent trading sessions, fell from levels approaching $5,600 per troy ounce down to approximately $5,100. This represents a decline of 8.7% from its peak. To put this in perspective, the drop in gold's value effectively erased $3.4 trillion from the total worth of all gold estimated to exist above ground worldwide. This calculation is based on current assessments of global gold reserves and highlights the enormous scale of value fluctuation that occurred within a single trading day. Silver's trajectory proved equally dramatic. The white metal, which serves dual purposes as both a precious metal for investment and an industrial commodity crucial to emerging technologies, reached heights above $121 per troy ounce before retreating. At its lowest point during Thursday's session, silver traded at approximately $107. The decline from peak to trough represented an 11.9% drop. What makes silver's recent behavior particularly noteworthy is the context of its January performance. Across the month, silver had surged more than 68% higher, representing the strongest monthly gain for this metal outside of December 1979. The reference to that specific historical period is significant, as December 1979 occurred during a legendary precious metals boom driven by the Hunt brothers' attempted corner of the silver market, a period that remains infamous in commodity trading history. The catalyst for Thursday's precious metals retreat appears intimately connected to developments in the technology sector, particularly among companies at the forefront of artificial intelligence and cloud computing. Microsoft, the world's largest software company, experienced a devastating market reaction following the release of its quarterly earnings report. The company's stock price plummeted by 11.9% at the New York market opening. This dramatic sell-off resulted in Microsoft losing $250 million in market capitalization within hours. The trigger for this investor exodus was information contained in the earnings report that indicated a slowdown in the company's Azure cloud computing division and its artificial intelligence data segment. These business units had been viewed as key growth drivers for Microsoft, and evidence of deceleration sent alarm signals throughout the broader technology sector. Microsoft's troubles did not remain isolated. Other major technology companies with significant exposure to cloud computing and artificial intelligence also faced selling pressure. Oracle, a prominent cloud computing and data management giant, saw its stock price decline by 5.4%. This decline occurred amid mounting concerns among investors that the artificial intelligence sector, which has driven enormous stock market gains in recent years, may be approaching a bubble that could burst. Chipmaker NVIDIA, a company that has become synonymous with artificial intelligence processing hardware and has seen its valuation soar on AI enthusiasm, lost 2.7% of its value at the market opening. The connection between these technology sector movements and precious metals prices illustrates the complex dynamics currently at play in global financial markets. After reaching their lowest points of the trading session, both gold and silver staged partial recoveries. The metals rallied back to levels that had represented all-time highs earlier in the week. Specifically, gold recovered to prices that had marked new record territory on Wednesday, while silver bounced back to levels that had been unprecedented highs as recently as Monday. This intraday volatility, with sharp declines followed by significant rebounds, underscores the heightened nervousness and rapid sentiment shifts occurring among market participants. The speed and magnitude of these price swings have raised concerns among market analysts and trading professionals about the sustainability of current market conditions. Expert commentary on Thursday's events has focused heavily on the role of volatility itself in exacerbating market movements. Ole Hansen, who serves as a commodities analyst at Saxo Bank, a derivatives trading platform, offered insight into the mechanics of what occurred. Hansen characterized the situation as volatility feeding upon itself in a self-reinforcing cycle. He explained that as price swings become more intense, the liquidity available in the market becomes thinner. Banks and market makers, who play crucial roles in providing continuous pricing and facilitating trades, face increasing difficulty in managing their risk exposure during such turbulent conditions. When these institutions become reluctant to quote prices for large transaction sizes, overall market liquidity deteriorates further. This liquidity decline in turn causes volatility to expand even more dramatically, creating a challenging environment for all market participants. Another market professional echoed concerns about structural challenges facing precious metals trading. Simon Biddle, who holds the position of head of precious metals at brokerage firm Tullett Prebon, emphasized the constraints faced by financial institutions in these markets. Biddle pointed out that banks do not possess unlimited balance sheets available for trading precious metals. The capital that banks can commit to making markets and taking positions has limits, and in highly volatile environments, these institutions naturally become more cautious. As a result, trading volumes have decreased as banks reduce their risk exposure. This reduction in institutional participation can create conditions where price movements become more exaggerated, as there are fewer market participants willing to step in and provide the other side of trades. Examination of trading activity in various precious metals investment vehicles provides additional context for understanding Thursday's market dynamics. The GLD Gold Exchange Traded Fund, which ranks as the largest such product for gold investment, experienced a significant surge in trading volume on Wednesday, the day preceding Thursday's dramatic price action. The volume level reached the heaviest seen since late October, when gold prices had jumped through the $4,000 per ounce threshold. High trading volumes in such products typically indicate heightened investor interest and can signal either strong conviction or significant uncertainty among market participants. Silver investment products displayed different volume patterns. Exchange-traded funds focused on silver saw trading volumes retreat further from the record levels that had been established on Monday. The SLV Silver ETF, a widely followed product in this space, experienced declining participation following Monday's extraordinary activity. Similarly, trading volume in COMEX silver futures contracts, which represent commitments to buy or sell silver at specified future dates, also fell for a second consecutive day. These declining volumes in silver products stand in contrast to the metal's dramatic price movements and suggest that much of the price action may have been driven by a relatively smaller group of active traders rather than broad-based investor participation. Gold futures trading showed a different pattern from silver. Activity in COMEX. Gold futures contracts rose on Wednesday after having dropped from a 3-month high reached on Monday. The return of higher volumes to gold futures markets indicates sustained interest in trading the yellow metal despite, or perhaps because of, the dramatic price volatility. Futures markets play a crucial role in price discovery for commodities and can provide insight into expectations about future price directions. Beyond precious metals, Thursday's market turbulence extended to other commodity sectors. Base metals, which include industrial metals such as copper, aluminum, and zinc, experienced sharp declines after having recently leaped to new all-time high prices. The prior surge in base metals had been triggered by a sudden easing of financial regulations affecting real estate developers in China. China represents the world's largest consumer of industrial metals, and policy changes affecting its construction and development sectors can have substantial impacts on global metal demand. The subsequent decline in base metal prices on Thursday reflects the same risk-off sentiment that pressured precious metals. The energy sector also experienced notable movements. Crude oil prices fell from a 6-month high that had been reached amid circulating rumors. These rumors concerned potential military action by the United States administration under President Trump against Iran, with speculation suggesting such action could be designed to spark revolutionary regime change in that nation. Geopolitical tensions in the Middle East historically have significant impacts on oil markets due to the region's crucial role in global petroleum production and transportation. The retreat in oil prices on Thursday suggests either skepticism about the rumors or a reassessment of their likely market impact. Currency markets provided another dimension to Thursday's financial landscape. The United States dollar showed modest strength, edging higher from the sharp decline it had experienced earlier in the week. The DXY index, which measures the dollar's value against a basket of major currencies, had plunged to 4-year lows in recent trading sessions. Thursday's uptick represents a partial stabilization, though the dollar remained near those multi-year weak points. Currency movements interact with commodity prices in complex ways, as most commodities are priced in dollars globally. A weaker dollar typically makes commodities more affordable for holders of other currencies, potentially supporting commodity prices, while a stronger dollar can exert downward pressure. The confluence of these various market movements, spanning precious metals, technology stocks, base metals, energy commodities, and currencies, illustrates the interconnected nature of modern financial markets. Developments in one sector rapidly propagate to others through multiple channels, including investor sentiment, capital flows, and direct economic relationships. Thursday's events demonstrate how concerns originating in the technology sector, specifically around artificial intelligence and cloud computing business models, can trigger substantial reactions in seemingly unrelated markets such as precious metals. This occurred as investors reassessed risk across their entire portfolios and adjusted positions accordingly. The historical context of January's precious metals performance adds another layer of significance to Thursday's developments. Silver's gains of more than 68% across the month represent truly exceptional performance. For this gain to be the strongest monthly advance outside December 1979 places January's action in rare company indeed. The 1979 period represents one of the most famous episodes in precious metals history, when silver prices skyrocketed from around $6 per ounce to over $50 in a matter of months, driven by massive accumulation by the Hunt brothers of Texas. That episode ended in spectacular collapse and led to significant regulatory changes. While current circumstances differ substantially from that historical event, the invocation of that comparison underscores just how unusual January's price action has been. Gold's trajectory to levels approaching $5,600 per ounce also represents remarkable appreciation over longer time horizons. The yellow metal has traveled a long journey from levels below $2,000 per ounce that prevailed in prior years. The path to current price levels has been driven by multiple factors that market observers have identified, including concerns about currency devaluation, geopolitical uncertainties, and the role of precious metals as portfolio diversifiers. The fact that gold peaked just $5 per ounce beneath the $5,600 level on Thursday before retreating highlights how close the metal came to reaching that psychological milestone. The notion of $3.4 trillion in value being erased from global gold holdings in a single day's decline requires careful consideration of what such figures represent. This calculation takes the decrease in the per-ounce price of gold and multiplies it by estimates of the total quantity of gold existing above ground worldwide. Geological surveys and industry groups maintain estimates of cumulative gold production throughout human history, accounting for mining output while excluding gold that has been lost or remains unrecoverable. The vast majority of gold ever mined remains in existence in some form, whether in jewelry, bars, coins, or industrial applications. When the price per ounce changes, the theoretical value of this entire global stock changes proportionally. Thus, an 8.7% decline in gold's price translates to an 8.7% decline in the value of all above-ground gold, yielding the $3.4 trillion figure. This represents notional value change rather than actual wealth destruction, as no physical gold disappeared, but it illustrates the enormous scale of the precious metals market. Industrial demand for silver has become an increasingly important factor in that metal's price dynamics. Unlike gold, which finds primary use in jewelry, investment, and central bank reserves, silver possesses properties that make it valuable for numerous industrial applications. The metal's excellent electrical conductivity, thermal conductivity, and reflective properties result in its incorporation into a wide range of technologies. Artificial intelligence computing infrastructure requires substantial quantities of silver in various components. Green energy technologies, particularly solar panels, utilize significant amounts of silver. The growth in these sectors has contributed to expanding industrial demand for silver, even as investment demand has also remained robust. This dual nature of silver as both industrial commodity and monetary metal creates unique supply and demand dynamics that differ from gold's more purely financial character. Thursday's price action occurred in the context of this ever-increasing demand from technology sectors, making the sharp decline all the more notable. The comments from trading professionals about banks' limited willingness to commit capital to precious metals trading illuminate important aspects of market structure. Financial institutions that make markets in precious metals must maintain inventories of physical metal or derivatives positions that allow them to facilitate client trades. During periods of extreme volatility, the risk associated with these positions increases substantially. Prices can move dramatically between the time a bank commits to a trade and when it can offset that exposure through other transactions. Banks must allocate capital to cover potential losses from these positions, and regulatory requirements following the financial crisis have made capital more expensive and less readily available. Consequently, when volatility spikes, banks rationally choose to reduce their market-making activities, quoting smaller sizes or wider bid-ask spreads. This withdrawal of liquidity providers ironically makes the market more volatile, as Ole Hansen described, creating the self-reinforcing dynamic of volatility begetting more volatility. The situation described by these market professionals presents challenges for all market participants. Large institutional investors seeking to establish or modify significant precious metals positions may find it difficult to execute trades at desired prices when liquidity is impaired. Smaller investors utilizing retail platforms may face wider spreads between buying and selling prices. The overall efficiency of price discovery can be compromised when fewer participants are actively quoting and trading. These considerations raise questions about market structure and whether current arrangements adequately serve the needs of the precious metals market during stress periods. Thursday's events also raise questions about the relationship between technology sector performance and precious metals prices. Traditionally, precious metals have been viewed as defensive assets that perform well during times of economic uncertainty or stock market weakness. Gold in particular has carried the designation of a safe haven asset, attracting investment flows when confidence in other assets declines. However, the correlation patterns observed recently have been more complex. The simultaneous occurrence of technology stock weakness and precious metals decline suggests that in the current environment, selling pressure in one area of the market may trigger selling in others as investors raise cash or reduce leverage across all positions. This differs from the traditional flight to quality pattern where money exits risky assets and enters safe havens. The market dynamics on Thursday may reflect forced liquidations, margin calls, or portfolio rebalancing rather than fundamental reassessments of precious metals' long-term value. This concludes part 1 of our comprehensive coverage of Thursday's extraordinary developments in precious metals markets and related financial sectors. The scale and speed of price movements in gold and silver have captured the attention of market participants worldwide and raised important questions about market structure, volatility dynamics, and the connections between seemingly disparate market sectors.